Howdy, Jacob here. Today we're looking at Genpact Limited in the professional services industry, 9.1 billion market cap, half a billion higher enterprise value. They provide business process outsourcing and IT services in India, rest of Asia, North and Latin America, Europe. Operate through three segments: financial services, consumer and healthcare, and high tech and manufacturing. Been around since 1997, based in Bermuda. Revenue growth is very impressive. Over the last 10 years, we saw the lowest revenue growth actually last year, 2.4%, and as high as 17.3%. Very consistently in that 4 to 9% range. That's going to deserve a premium in my eyes based on the fact that people love consistency. Are we seeing that on the bottom line? We are. So gross margin down a little bit from 10 years ago, but we are seeing an increase in operating margin from 10 years ago. Very consistent, very consistently increasing. All positive signs. Paying a dividend, that's another sign of positivity for the business. People like consistency. You are consistent, you pay a dividend, and that dividend is well below, that's about 20% of their earnings per share paid out in a dividend. And so we'll look at a free cash flow basis, see what that payout is, but very likely, very reasonable. Most all their costs is cost of goods sold. Hitting that gross profit under 50% makes sense. Balance sheet shows 648 million cash on hand, 23 million in short-term investments, with 26 million short-term debt, 1.2 billion long-term debt. So they have about 600 million net debt, and they make that almost in a year. And so balance sheet, beautiful. Increase of free cash flow, beautiful. Their use of cash is mostly share repurchases and dividends, with a little bit of money towards acquisitions at this point. But for the last couple of years, we are seeing mostly share repurchases and dividends. And that dividend payout is going to be about 20% at this point. The last 12 of the rolling 12, it's actually less than 20% payout. So very affordable dividend. Use of money of share purchases and dividend, pretty common for a professional services industry. Let's get to it. Let's make some assumptions here. So revenue growth, they've been pretty darn consistent. Let's assume a little bit of money goes to acquisitions. I think they can grow 7% a year. I think that's pretty reasonable. Net income margin, free cash flow margin. Over here, we're seeing margins, roughly 10%. Free cash flow looks to be a little bit higher. I think I like 10 and 11%. Share change, what's buying back? Let's say 50% of their free cash flow. So free cash flow, let's say, is about 500 at this point. That means share purchases with 50% allocation would be about 250 million. Reduce it by the stock-based compensation, assuming everything gets turned into shares. We're a little under 200 million, and that's going to be about 2% of the market cap. So that's how I get to, repurchasing of it. So reduction of 2% per year. Obviously, that's an assumption. The market cap's going to change daily. The free cash is going to change, but this is just part of the assumption process that you have to do. 7% growth rate, a little bit through acquisition, but okay, pretty good return on invested capital, likely above the weighted average cost of capital, meaning they're creating business. But again, most of that money is being invested towards share repurchases and to dividend, not as much towards business organic growth. And so for that purpose, they just the upper end of the market average at this point. For a dividend, let's increase that. What have they done historically? About 10%. Let's increase that by the dividend amount, or by the revenue growth amount, saying that payout stays roughly 20%. And at that point, stock needs to fall 34% before you get the return looking for here. And so, let's actually bump this up one more. Because again, it was so consistent of a business. The lowest revenue growth for the last 10 years was 2.4%. I think that's going to need a little bit of a premium. And so 30% drop before you get the return we're looking for here. In my eyes, that's pretty darn close. I think, you drop this to 10, you can get pretty much market turn here. But obviously, I'm looking for more than that, given it's a single company, a lot more risk involved. But really not too far off. Love to do a deeper dive here, see if I'm pretty close with these metrics. But at this point, still need to follow a little bit more from it. Hope you enjoy this video and have a great